Hello and welcome to today's episode of Nucleus Investment Insights. The topic of discussion today is, are commodities the new reserve currency? Recently, Zoltan Pozsar, a Credit Suisse analyst, published a research memo titled Bretton Woods III. Zoltan is widely seen as an expert in financial plumbing, central banks and monetary system, and is not worth dismissing lightly. He argues the West sanctions against Russia were an inflection point that would push the world economy into a new world monetary order away from the dollar-based hegemony. On the agenda, we'll discuss the pros and cons of this thesis. Next, we'll look at the rise of Chussia, the growing allegiance of China and Russia. Next, we'll delve into captured commodities and how this will affect currency transactions and the eventual impact on the current world order. Finally, we'll discuss where we think he's right, where we think he's overstating the effects, and the investment implications for markets. Today, as always, I want to welcome the founder and chief investment officer at Nucleus Wealth, Damien Klassen. Damien, thanks for putting on this great podcast, and welcome on this sunny Melbourne winter day.
Thanks, Sam.
And today we're also joined by our chief strategist at Nucleus Wealth and macro business founder, David Llewellyn-Smith. Dave, thanks for joining us also.
Pleasure, Sam. Thanks for having me.
Welcome. My name is Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform. Our show is available on all the majors. And just an FYI, if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, we'll get started. So Damien, please lead us away.
Yeah, thanks, Sam. So it's a little bit of more of a technical look. It's a little bit more of a technical episode now than what we often have, and what we're trying to look at here is that the world monetary system's been through a few quite large changes. If you take on a sort of century-long basis, moving off the gold standard, moving on to sort of the US dollar, sort of switching from the British pound across to the US dollar as being sort of the key reserve currency. And so whenever you have sort of a high profile and quite well thought of analysts sort of coming out and talking about maybe we're going through another shift, it's always worth sort of peeling back the layers and actually just examining what's going on. So there's the analyst from Credit Suisse, Zoltan Pozsar, he's sort of been written up on, he's been written up by a couple of like the Wall Street Journal and Financial Times in recent weeks, sort of talking about his posts from earlier on this year, and so what we wanted to do is sort of examine what arguments he's making, and then talk about which ones we think are overstated and which ones aren't. So the net effect of what he's talking about is a shift away from to what he's calling Bretton Woods III. The effects of that, what he's suggesting is going to be higher inflation, higher interest rates. You're going to see commodity reserves replace foreign exchange reserves. You're going to see a lot more trades in other currencies, and as a result, you're going to see a lower US dollar. And so that obviously makes a big difference if that sort of is coming through. He talks about sort of the four prices of money as part of this, and this is I guess a precursor to what the argument is, as opposed to actually the argument itself. But money's got basically four different prices that it has. One is what you call par. So, and the idea behind this is that it's the price of different types of money. So if you've got a money market fund, you'd expect that money market fund to sell, a dollar's worth of assets in that should be, be able to bought and sold at a dollar, or very very slight difference to that as sort of the buy sell spread as you're coming in, and it's this idea that if a dollar is not worth a dollar, a dollar in one asset, one very highly liquid, safe asset is not worth a dollar, then then you can start, that could sort of cause crisis. And that was 2008. A lot of the problems we saw there was because the money market funds effectively broke the buck and were trading for less than a dollar, and that then meant that that the assumption that so many people had in the way they'd finance themselves meant that could have flowed on to create massive, effectively a financial system meltdown, and which is why we saw the Fed step in to sort of backstop that. Your second price is interest rates, and so this is sort of pricing future money, including sort of spreads for liquidity or for credit and things like that. So it's basically saying, well, there's a price to say, I've got money today. I'm going to give up my liquidity by having that money, and I'm going to give it to somebody who's going to give it back to me in say I'm going to give it to a government, and they're going to give it back to me in 5 years' time, or I'm going to give it to a corporate who's going to do the same, or I'm going to give it to a bank, and I'm going to get back tomorrow. There's some sort of price for that in terms of what that's worth. So then we and that's where 2020 the crisis sort of as the pandemic hit, that's where we saw this idea that there's a lot of bond sort of relative value trades out there where effectively what they've done is long one asset and short another asset, and because we saw this complete blowout in terms of corporate bonds, what was happening was good collateral was then having to be sold to meet demands for the poor collateral that just couldn't be sold. And so we again needed the Fed. This time we needed the Fed to step in and save us from that problem that could have been a crisis there. Your next price of money is foreign exchange. And so that's the price of one currency into another currency, and making sure that there's a sort of a fair swap depending upon what assets are available, what can be made in one country versus made in the other country, and things like that. And a crisis that came when that foreign exchange price of money was created. An issue was the Asian crisis in 1997, when we had a whole bunch of countries throughout Asia who faced this run on their currencies, and so and that sort of brings him through to the final one, which is your prices. The prices and prices more specifically of commodities. He likes to focus in on in terms of saying that's so you've got your par, which is your money market funds, your price of interest on money, which is your interest rates, your price of foreign exchange, and finally this idea of prices, basically inflation type measures, and more specifically the price of commodities. And he's speculating that maybe 2022 has actually seen a break in that, because a commodity produced in Russia, a barrel of oil, for example, is no longer the same price as the same barrel of oil produced somewhere else in the Middle East or in the US or somewhere. And so he sort of takes a fair go, sort of drives into that a bit more, and I guess it's this speculation. Look, if he's right, and there is a structural break in terms of the price of commodities, then what does that actually mean? Can that result in a crisis? One of the things he notes is that, look, when we had a foreign exchange problem, the IMF could step in and sort of backstop some of these countries, and other central banks could sort of band together. In terms of problems with par and interest, we've got central banks that can step in and solve these problems. Issues with commodities is a lot harder. The central banks can't print commodities. It's not something that's solvable or easily solvable by a central bank. And arguably that's what we've got now is the Fed effectively saying it's going to keep raising rates until it breaks the oil price and brings back the inflation into more normal realms. So so that's the sort of overall thesis behind it. So I should sort of also step in. Actually, Dave, is there anything on that big picture I've missed from your perspective?
He says the point of where you're sort of shifting from one monetary system to the other is in the basis of the price of commodities is the only the buyer of last resort in commodities is basically China.
Yeah, that's
And
right.
so-
And is
and so
China the
that-
central bank? Yeah.
Yes, and so that's kind of implicitly positioning China purchasing power and commodities as, a kind of reserve, a functional reserve, if you like, which may come to rival our existing system. But we'll get into that in more detail.
Yeah. So then I should sort of give a quick background in terms of the current system that we've got. So since we went off the gold standard, Bretton Woods II is effectively a system where the US dollar sort of underpins cross-border transactions. Most things are priced in US dollars. US treasuries tend to be the collateral. What that means is that in practice is that the US has had to run relatively large deficits treasuries that other people could use as then buy and use as collateral. But it's also given rise to this idea that this huge euro dollar market, which is effectively US dollars that are issued outside of the US. And so, and despite the confusing name of euro dollar, it doesn't necessarily have to be in euros that the flip is around. But effectively, it's a for argument's sake, it's a European bank or an Australian bank or somewhere outside of the US, which is taking deposits in US dollars and making loans in US dollars as well. Usually to corporates or sometimes to individuals. So the issue with that is,
and it's huge.
It's massive, yeah, and it's completely outside the control of the US.
Yeah.
So, because these are banks that aren't even in the US. It's effectively people taking bets on what's happening in the US dollar, completely outside the system. So, and that's you can spend a long time talking about the euro dollar. So I'll sort of try and leave it at basically that. Is there any other big picture things with the euro dollar I should mention, David?
No, I think that's good enough.
That's probably enough. Yeah. So the idea now is that Zoltan's pushing is that Bretton Woods III is this idea of commodities actually starting to form. So the US seized a bunch of global, not just US, but NATO countries, US and NATO countries, just seized all these reserves of Russia. And the idea is that, well, if foreign currency reserves are no longer, a safe form of asset because the country you put it in could just seize it, then does that then lead to a breakdown of trust? And furthermore, it's that the safer place to store your wealth is then in commodities, because commodities can be switched around between. I guess they're much less likely to be seized in that format, and you end up with this sort of Bretton Woods III, where it's a China and Russia in particular with commodity collateral, with sort of underpinning the yuan as a reserve currency, and what's being discussed as being a Eurorenminbi monetary system, which is effectively similar to the euro dollar, except it's Chinese yuan being issued in foreign banks, and Chinese, both assets and liabilities. So I guess the point he's got is that that leads to a lot of instability. We've got a couple of these charts, Sam, I might just pull up. One's basically for anyone sort of listening in and can't see the slides. It's basically it's a triangle with sort of flows of money and commodities back and forth between financial stability and price stability, and also between geopolitical stability and price stability, and then treasuries is sort of is the bottom of the triangle, which is sort of flows back and forth from that geopolitical stability. And the idea is that he's then got another chart which is saying, well, when that breaks down, what happens is you end up with two systems. One is the usual system, which is still between countries like Europe, Japan, the US, and that's sort of sitting on one side. But then on the other side, you have a Bretton Woods III type system where Chinese bonds are sort of flicking and creating your financial stability for you, your commodities, and payments back and forth for commodities in Chinese yuan is what's sort of stabilizing that system, and then and that's going to lead to price instability in the in anyone still left on the old system of Japan, Europe, and the US, and Australia obviously as well.
And so that's hence, this notion of a return of the gold standard, really, except instead of gold, it's all commodities that are underpinning this Bretton Woods III system that pivots around the renminbi instead of the US dollar.
Yes, yeah. As you said, it is very similar in terms of being that your gold was your reserve asset, and that's your thing. You could always keep benchmarking yourself back to as a price.
Yeah.
In this case, it's effectively all commodities, whether it's primarily oil and gas and probably copper and iron ore, you sort of big commodities that sort of make that up. Yeah. Okay. So that's the thesis behind it. I guess that sort of leads on to this idea of captured commodities. I might let you talk through that, Dave. Captured commodities.
Sure. So, obviously commodities are everywhere, but they're also within certain sovereigns and monetary systems as well. And with the rise of this alliance between China and Russia, and the instability that is arisen in Bretton Woods II, as the US has sanctioned Russia, etc. The question is, do these captured cost commodities trade like they used to, or are they going to operate within new kind of hegemonic structures, I guess, new monetary empires underpinning bonds and currencies of the countries that actually own the reserves or have exclusive access to them. And so in the case of what I've called Chussia, which is just Russia and China, obviously, could have called it Reiner, I guess, but it didn't sound quite as good. Russia is an enormous energy exporter, huge energy reserves, quite big in some metals as well, and grains and food, etc. and stuff too. And right now, the sort of free world is sanctioning it. All of those reserves are completely out of bounds for themselves, which is leaving Russia to exclusively trade with a very limited number of mostly autocratic states, including China and Iran, and there are some kind of crossovers from this liberal system and illiberal system. It's not like they're completely mutually exclusive. So, for instance, India is a very big trader of commodities with Russia, given its strong kind of communist history. And so it has a very long and deep historical relationship with Russia. And so it kind of straddles both systems, if you like. But the basic notion is that, these captured commodities are going to be more and more constrained in terms of the free trade of them, giving rise to, the possibility of new kind of monetary systems around them, which is kind of where we get to what Damo was talking about with, the rise of a Euro-Renminbi market, which would be kind of crucial development if the yuan was going to, genuinely threaten the US dollar reserve system. If you get enough of this kind of captured commodity trade, and these autocratic states make new kind of bilateral trade agreements to trade in currencies outside of the US dollar, then you can sort of see a point where even those outside of that system who need to get access to some of those commodities, will be forced to also trade in the Euro-Renminbi market. Like they'll be creating assets and liabilities in yuan as part of that entire kind of trade to get access to those commodities. So, there is something in this in terms of, kind of an evolution for the monetary system. The question is, I guess, how far does it go and how destabilizing is it for the existing system? So, where is Zoltan right and where is he rigging the case? So,
because I think it's important to say that we agree that a lot of this, the directional stuff is right. It's just a question of saying, does this turn into, trade between China and Russia, gets traded in yuan or possibly rubles, but more likely to be yuan, and it sort of goes as far as that, or does it spread, as you spoke, to a whole bunch of range, and it all of a sudden sort of starts to threaten existing world orders?
Yes, that's right. So, yeah, I mean, we more or less agree with the thrust of what he's saying. I think he's describing something that is happening. But there are a number of reasons to think that it's more of how can I describe this? An evolution on the sort of a monetary polyp growing off the existing system rather than necessarily something that threatens it or destabilizes it. And there are a bunch of reasons for why we think this is the case. The first is, if you want to make commodities into reserve assets, well, they are very volatile for starters, and much more volatile than treasuries would be, or are, or US FX for that matter. I mean, commodities, by their very nature, because they high prices cure high prices in commodities, and low prices cure low prices in commodities, because they're everywhere. That's why they're called commodities. And even though some very large commodities are captured, there are an awful lot of them everywhere else as well. And so if you developed a reserve system or based around them, you could very easily see not just business cycle crashes, huge spikes and crashes in prices of commodities that would make them very difficult to use as reserve assets, but also commodity cycles in and of themselves as well.
Australia is like a little bit of a microcosm of that, isn't it? Like
absolutely,
the Aussie dollar, heads up to
exactly right. I mean, Australian dollar is a beautiful example of a commodity currency. I mean, it's a price of an asset that's linked to a commodity reserve. In effect, that's a big part of what makes the value of the Australian dollar, and it's absolutely wild, right? It's one of the most volatile currencies in the world in terms of developed markets. So, that's going to be a factor in it, and a secondary to that, if we're talking about really how the supply side of commodities works, is they're also highly fungible. So you may have a captured commodity today, it might be, say, a battery mineral or something that you think is red hot and you've got heaps of it, or you've got a big reserve of it and others don't. But, if that's the case and you price yourself out, then there are probably half a dozen or a dozen alternative commodities that can come into that gap, and the batteries just adapt. I mean, that's a microcosm of a lot of stuff in commodities and their use in their industrial uses. There are substitutes in all sorts of things on the supply side for commodities. Sorry, you were going to say something?
I was just going to use the example of copper and aluminium, which are both sort of conductive and can be used in various electrical applications. Copper's way better usually, but if you've got particularly low energy prices and for at least a portion of the users, aluminium suddenly becomes a reasonable alternative at certain price points when between the two. And
Yeah.
so it just sort of, that's just one example, but there's hundreds of others.
There are. And I was going to use
gas-
the gas example, which is just, as an energy, generating commodity. You look at what we have right now with enormous gas prices, but if you fast forward 5 years, when Europe is radically building out its renewable capacity, then suddenly you've got substitution of gas going on a pretty big scale, and so your gas is suddenly not worth all that much. And indeed, if you're looking at the long term for sort of sovereign reserves and things, buying something like gas might seem a good idea right now, but if you fast forward in 20 years, when everybody is building out their renewables and their energy storage systems, we might find ourselves with an enormous gas glut, and suddenly your reserves are worthless. So commodities simply work differently to some of those other prices that Zoltan listed as possible reserves for a monetary system, and they're not altogether promising, to be honest. They could be very volatile indeed. So that's the first kind of fly in the ointment. The second one is, is what's in this for China? We all know that they would like to internationalize the use of the yuan, and like most pundits, geopolitical pundits, think that the yuan, if the Chinese sort of illiberal empire is ever going to displace the US version, the liberal empire of the US, then it'll have to substitute the reserve. It's as the reserve currency. There's probably something in that, but the question is China prepared to wear the exorbitant privilege of doing so when everything about their economy is mercantilist? And so, implicitly, if you're going to end up with a Eurorenminbi market, you're going to end up with a higher yuan. You'll have to lose the dollar peg, and you'll have to start issuing all of this debt and become, effectively a current account deficit country to support the existence of your reserve currency. Now, China may be willing to do this in theory, and indeed it's talked up that process for the last decade since Xi Jinping got into power, but it's always backed off from actually doing it. And I think the reason why is that the Communist Party of China, it can't let go of control of certain components of the political economy that it needs to if that process is going to transpire. For instance, if it was going to shift a lot more of its economic activity to consumption instead of the supply side investment that drives it at the moment, then you're going to have to privatize a whole lot of SOEs. You're going to have to shift all of the income flows in the economy away from those captured SOEs and more towards households where you simply can't control it as much. And that is quite a liberalising process. That comes with quite a bit of freedom, and you've got to ask yourself, can the CCP actually sustain that? And if that's the case, I don't think they can, to be honest. I don't think they think they can either, which is why they talk about it, but only edge towards it without really doing any of the big reforms needed to bring it on.
Yeah, and for the other countries involved as well, it's this idea, pick a country, say like an Argentina or someone that's sort of a bit, let's say, a little bit separate from any being on any particular side in this. And the thing for them is saying, well, do I want to get paid in US dollars and run the risk that yes, the US could seize my foreign exchange reserves at any time if I decide to attack another country or do something that's whatever, or do I want that money sitting in renminbi where the CCP could do exactly that because I happen to. We had freedom of press, and somebody in my press wrote, similar to what they've done with Australia, where they've,
exactly
they've banned all these this trade because, we mentioned that maybe we should find out where COVID came from,
Yes.
And so,
and that's an almost unbelievable scale of regulatory risk or sovereign risk.
Yes.
Really, that I don't think that it I mean, even though the US may have seized Russian reserves, I mean, that seems to me still infinitesimal versus putting your money in Chinese assets and thinking that Xi Jinping's going to look after you.
Yeah, exactly. It's a question of saying, okay, well, if I don't attack other countries and cause worldwide condemnation, I'm probably all right with my reserves. Versus if I don't accidentally say something that offends Xi Jinping.
Yeah, exactly right. I mean, you read your kid Winnie the Pooh, and you lose 300 billion in assets. So it's I mean, that's a huge problem. The opacity of the Chinese system is just an enormous problem, and the overhang of the tyrant is very difficult. And we've actually seen that play out post Russia with a fair bit of capital outflow from China, some of which was related to more cyclical factors, but I think it certainly was partly owing to China's support of Russia and the prospect of China seeking to reunify with Taiwan, in which case the liberal empire and the Bretton Woods II system would sanction the shit out of China. They'd basically apply the same sanction regime that they have to Russia to China. I think that's fairly likely, and so there's potentially enormous instability in this. If this Eurorenminbi system were to begin to evolve, there's an extraordinary sovereign risk in it as it does so. It doesn't look like a safe haven play in the short term, anyway. I mean, kind of tipping into that, there are other more sort of slightly more tactical factors, I think, like, again, you've got a lot of swing states around the place that, kind of flirt with China, but they still exist more or less within the US alliance network, either implicitly or explicitly. So you can take a country, say, like Saudi Arabia, which obviously has huge oil reserves and has contemplated trading some of those in renminbi, or threatened to at various times. But for instance, it buys some extraordinary quantity of its weaponry from the US. Like, it's 90%, something like that. It is utterly dependent on US arms manufacturing. Now, it's not an explicit US ally, but implicitly it is. It's utterly dependent on US defense industry, for instance. And so that the whole US hegemonic system has penetration into states at critical kind of levels that mean it's more difficult for them to start to play around with a new monetary system than it appears, because there could be life-threatening consequences for governments and regimes. So in the case of Saudi Arabia, for the monarchy, for instance.
And the question is, for those, can they switch to, say, Russian planes and Russian weapons? And that's, we've already seen that Russia themselves have been buying washing machines in order to take the chips out of them, to put the chips into their rockets, because they can't get the chips that they need to fire some of these things. And so there's, it's a, it wouldn't be hardened from that perspective.
No, I mean, you could shift, absolutely. And doubtless Chinese defense industry will rise as well in time with its alliance network. But that's not something you can do lightly or overnight, or even in the span of decades, if you're that integrated with US systems. I mean, you're talking about a legacy of national defense going back 50, decades, even a century. So.
And it's one thing to say to stiff your your French submarine partner to go with a British or a US one, because they're part of the same same network of same, you're under the same umbrella. But if you told the US, I'm not going to buy any more of your missiles anymore because I'm going over to buy Russian ones, if they don't work, you can't turn up 3 months later and say, oh, actually I've changed my mind. You can't sort of, I'd like those US weapons because they may not be available for sale anymore.
Yes, that's right. So all of these things are kind of big headwinds or speed bumps for the development of this Bretton Woods III system. That said, as we said to begin with, we agree that Zoltan is describing something that is happening. It's just a case of how swiftly and how large it can get. And there is one other dimension to the supply side of commodities, which hints at the possibility, at a second possibility, and that is just cheap sanctions.
Yes.
Which has given rise to some enormous trade and some very large companies over the years, like Glencore, for instance, is the fruits of almost pure sanction cheating over the years.
Much of its profits over the years And Iran's a good example. There's been a lot of Iranian oil leaking into the rest of the world, despite
and these things are very permeable as well. Like when you talk about captured commodities, like for instance, right now, as I said, India's buying oodles of Russian oil at cheap prices because
actually that was what Zoltan went a long way into talking about, the problems with getting Russian oil to India and China, and how it sort of added all this extra time into the supply chain. So rather than taking a couple of weeks to get it into Europe, you're taking months to get it down to India or to China.
Yeah.
But the issue is, and I get that argument, and it's true. Like it is going to create that,
and that is inflationary.
And it's inflationary. Yep. It's a one-off hit to inflation, because once it goes, okay, my supply chain used to be whatever, 2 weeks. Now it's 2 months. And so therefore I've got a one-off hit to the cost, but it's not necessarily inflationary ongoing.
Yes.
And just to give you an idea of the figures, so a very large crude carrier, which is sort of a standard size ship in oil terms, carries about 2 million barrels of oil, and costs about $100 million. So, I think Zoltan in particular talked a lot about saying, it's going to be hard for Russia to get hold of these ships, and maybe people won't get insurance, and so they won't do it. And a lot of people just refuse to go to Russia. And that has been true to some extent. But the net effect is, if you're carrying 2 million barrels of oil on your ship, at today's prices, that's sort of $250 million worth of oil. You can bang on your ship, somewhere between 200 and 250 million barrels of oil. I mean, you could buy a ship, sail it from Russia to China and throw the ship away, and you're still selling your oil at $50 a barrel.
Yeah.
And so when the dollars are that large, there are plenty of people who will be willing to fly a different flag or whatever.
And what I was going to say about India as well is that they're starting to process that Russian crude into various forms of fuel, and they're exporting the fuel.
Yes.
Right. So, these things are just not as captured as they appear. And once again, there's just so many possibilities and substitutions, and fungibility is the key word when it comes to commodities.
Yeah. That's right. And when we say, is it easier? I guess the question is saying, well, if it's a choice between creating this whole new system around trading and a whole new monetary system, or do you just try and cheat the existing system? I think the answer for most people at the start, at least, is going to be trying to cheat the existing system.
Well, when the dollars are that easy, bloody hell. So I mean, investment implications.
Well, actually, before they do that, there's a few questions that people have.
Yeah.
had a few comments and sort of concerns with the theory coming through. So we've had one comment from Chris. He's saying gold is a commodity and it's already a reserve asset. Wouldn't that be the go-to commodity rather than a basket of different types? And Brett's also saying that wouldn't emerging markets get crushed by inflation in commodities caused by this Bretton Woods III? So do you guys have any comments around those?
Probably the other more relevant one as well is Sasha's also talking about how Canadian Central Bank doesn't have any gold reserves, and so what does that mean? So let's do the gold one first, because I think there's Canada's that great example. So the gold system was basically saying, I'm going to issue $1, and you can trust me to give you back $1 because if you want, you can come and I'll give you $1 worth of gold. I'll convert it through, and that was effectively the gold standard. The problem with that is effectively you're basing your monetary system on how fast you can pull stuff out of the ground, and the argument about, well, is that gold actually worth the dollar? And there's a whole bunch of more philosophical issues which effectively come back to a country's can it's what it can produce, really. If it's a country like Canada that produces lots of oil, produces lots of manufactured products for the US, it's got a very large services economy that can provide services to other countries. If it's if the Canadian dollar, for example, fell by 90%, well, all of a sudden everyone would want to be outsourcing whatever they could to Canadian employers, because they're reliable. They've got a strong rule of law, rank very well on corruption measures, all these types of things like that. Like the value of the Canadian dollar is what the Canadian economy can produce. It's not just about how much gold happens to be sitting in their banks, and that's that. So that's the Canadian side. I guess the question for Chris in terms of that, is saying, well, do you want to go back to that same asset again? Do you want to just go back to that and have all the problems that we had, and the US in particular had around gold? Is that something that's desirable to sort of base your economic system and around that, and run into the thing of sometimes you want to scale up your and add more liquidity. Sometimes you want to withdraw your liquidity from the market, and be based upon how much companies happen to be digging up out of the ground, or how much you happen to have stored in a vault at that point in time. Whereas it makes a lot more sense to have currencies where you can scale up and scale down a lot more quickly. Dave, you got any?
Yeah, well, that's right. Going back to the gold standard, if this kind of system were to evolve, I imagine gold would probably be part of it, and its credibility lift, I guess. Gold's become so mysterious in the last few years with the rise of crypto that I'm not quite sure where it's going next. So I struggle to answer that question, to be honest. On the other one, what would it do to emerging markets? Would it give them inflation? Yes, but it would also give them much higher currencies, because emerging markets have a lot of commodities, and that might just net out. It would. They'd face the same conundrum as China, basically, because they'd have to let go all of their dollar pegs, and so all of their efforts to export into developed markets would be really damaged, and so it'd be a massive kind of economic adjustment away from a lot of their export-driven models, towards domestic consumption, and again, there's not a lot of successful cases of emerging markets doing that well or successfully. So it would certainly pose a very big challenge to emerging markets.
Okay, thanks for that. There's one other one here. A question around, I don't know if you want to touch on it. What does a gold standard mean for modern monetary theory? Does that fit in there?
No. It's the end of monetary theory. It's basically the opposite end of the spectrum.
The opposite. Yeah.
Yeah. So, I think we could give a half an hour answer on that, or maybe it might be easier just to leave it at that. It's
Okay, that's great. We'll move on. So we'll have our viewer question of the week. So this is for viewers to have some discussion in the comments section over the coming days. The question for this week is the US dollar's reign as the reserve currency coming to an end? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. Guys, I'll hand it back to you, Damien, for the investment implications.
Yeah, so what we've done here is just lined up what Zoltan, we spoke about what Zoltan was saying at the start, and just sort of and what our view is on where it comes from. So the first one he had was higher inflation with this new monetary system. Look, given we're not expecting, we're expecting some of this, this monetary system to be a little bit of a last resort, say, between China and Russia and maybe a few other countries, is that we're expecting this to be a one-off effect, not an ongoing. So there's this one-off effect of supply chains are going to have to be much longer. There is going to be you will get supply chains, onshoring as well. So some countries will now decide that they're not going to produce things in China, or at the moment, there's countries moving, production that might have formerly been in Russia to somewhere else. So that will make an effect, but it's a one-off effect. There's no reason for that to actually keep causing higher inflation year after year after year. Chances are as well, a lot of those processes, when they do get onshored, will probably be largely automated, and which actually probably bakes in more deflation than what you might have seen if they were left in a country that's producing and subject to sort of rising wages. So yes, that's the higher inflation. The higher rates, effectively flows on. His view of higher rates flows on from the view of higher inflation. So that's sort of for us, it's more about going back to sort of pre-COVID levels. He's one of the main things he speaks about is commodity reserves replacing forex reserves. So basically, rather than holding billions of dollars in foreign exchange reserves, what he's suggesting is people will switch that and hold it now in commodity reserves. Look, for mine, it's going to displace some of it, but certainly not going to. It's not going to replace. And it comes back to that idea that if it's a question for the biggest economies in the world, US, Japan, Europe, Australia, Canada, those types of, you major economies are going to be much more likely to store things in foreign exchange reserves where it's fast and can move around, and rather than trying to build up massive commodity reserves that are obviously harder to switch in and out of, and harder to monetize when the time comes. He talks about more trade in other currencies, and we certainly agree to that. But we disagree that we still think that the US is going to be that sort of still be the basis of people trading, and trade in other currencies. It will be a last resort, say between places like Russia and China, or countries in the Chinese sphere of influence. And so then the thought of the lower dollar, it really comes back to that: is China willing to see their currency appreciate? Because in the end, that's effectively the argument, is that China will be willing to take on these, the role of that reserve currency and see their own currency appreciate. Whereas in the past, they've actually been very keen to hold their currency down at low levels in order to keep employment high in Australia.
In Australia?
Sorry. Keep it high. Well, keep it high in Australia. Sorry, keeps it high in China. It does keep it high. As a corollary, it keeps it high in Australia as well through mining. But yeah,
I guess I would add, if you agree with Zoltan, then the Australian dollar is probably going to go to $2 in the next 10 to 15 years, because we would be fantastically well positioned in that kind of monetary regime. But,
yes.
That's if you think that it can develop in the manner that he sees. which I don't see.
Yep.
Okay, yeah, jolly good, guys. We've just had another comment through from Chris G. He's saying points for both sides. He does feel like having some sort of anchor somewhere to restrain crazy monetary expansions, like we've seen over the last decade, would help in the long run. And he's just saying thanks for the answers to the questions. So yeah, that almost wraps us up. So Damien, Dave, thanks again for sharing your views and opinions. Very insightful stuff. And yeah, not sure this new world order is going to come in anytime soon, but definitely worthy of discussion. So thanks again, guys.
Thanks, Sam.
Thanks, Sam.
So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. So if you do have any ideas, please drop it in the comments section below, or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com and you can book a call with me or one of the team. And don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them now. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.